Good morning, everyone. Welcome to the Macro Snapshot. We are Wednesday, August the 6th, 2025, recording this in the morning. Again, a fairly quiet overnight session, not a huge amount of information or sort of market moving news. We do have a few things, so let's just catch up. What is interesting to me is just the market, having seen the non-farm payrolls and those big revisions last Friday, was interesting getting a little bit more sort of perspective on the US economy. And we got that yesterday in the form of surveys, so not hard data, just surveys. And it's interesting that the ISM services came in a little bit mixed, I would say, and with a sort of a stagflationary tilt. Why stagflationary? Because the prices paid up to almost 70, so higher than last time at 60.75 and higher than expectations had been expected to fall. So it looks like the input prices. I was just reading the report from the ISM, and they're saying that a lot of the commodities or the raw materials were sort of up, and even wages, so up to 70, which is very, very high sort of reading for prices paid. And that's a problem for the Fed and the incoming Fed sort of choice eventually in a few months, just because even though the Fed may want to cut and there's a huge political pressure to cut, as long as inflation and pricing pressure remains sticky, it's going to start creating a problem with their two mandates. They're going to start having to diverge a little bit. Anyway, just for the moment, the headline number came in at 50.1, so a little bit lower than expected. And essentially at this point, just at the level, sort of a flat kind of level here. Our new orders was a little bit less than last time at 50.3, and this one's not great. The services employment here at 46.4, so down. So that's now actually contracting. So what the ISM services survey at least is telling us is that prices remain a bit sticky. Input prices, employment is going down a little bit, and activity in general is a little bit flat. So not a horrible report, but definitely a report which seems to be, how can I say, which seems to be sort of reinforcing this idea that the US economy is not collapsing, but it is slowly weakening, especially the employment component, and there is not much relief for inflation. What is interesting, though, is that just looking at what's priced in for the Fed here, just like to have a nice look at this every morning. You can see here that for the September price, we've still got almost one cut priced in, so 90% price of a cut. So 90% probability of one cut for September. So the market is still believing that. And by the end of the year, pricing is still over two cuts. So there's still, about a third of a cut of sort of a premium, if you will, priced in. Now that is now at 57 by the end of the year. It had got as low as you can see here down to about 64. So the thing is, for me, it's interesting with the ISM services. The market has repriced a little bit dovishly in a couple of days since the non-farm payrolls. You can see this is the non-farm payrolls. As you see, we got down to about 64 basis points of cuts by the end of the year, and we have sort of repriced about 6 or 7 basis points, a bit more hawkishly, if that's the word. But still, the market is convinced that the Fed is going to cut even over two. Remember, 50 basis points would be two. So at this point, the market really is leaning on the fact that the Fed will cut, and it's not going at all back to sort of a hawkish pricing. So that's interesting, keeping an eye on that. In terms of other stuff, let's just look at a few markets and see what's going on. Oh, just in terms of like the Fed and the FOMC, Trump was on the news yesterday giving an interview, and he basically said that he could announce a replacement for Adriana Kugler, who is going to retire basically in the next couple of days. So that could be coming as early as this week. So that's going to be interesting. And it also could be interesting in case Trump says that person is his preferred nomination for the Fed chair as well. So not only to go on the board of governors, but also on the Fed chair. And people are talking about maybe Chris Waller and the two Kevins. There's Kevin Walsh and Kevin Besant. Kevin Besant, I think, and another person whose name I forget, David somebody. So it looks as though it's probably going to be between those three, one of the two Kevins, and Chris Waller, who of course is on the sort of the more dovish side. So let's see if we hear about that. And the other thing from the Fed today, we do get Governors Cook and Collins speaking. Now they are both voters, so they have quite a lot of sway. So that's going to be interesting as well if they, essentially sort of give any sense of where the Fed might be going in September and October, and indeed December. So let's keep an eye out for those as well. In terms of the bond market, let's have a look at the bond market. what we saw yesterday, you saw this is a huge move on Friday. This is the 2-year bonds, or the futures. So they have given back a little bit, as I think I said yesterday, hitting some overhead resistance. But again, let's keep this in perspective. It's not really collapsing in any shape or form. So if we put just the short-term fib, you can see we haven't even got down to a 38% fib retracement here. So this is normal, bit of profit taking. We're now getting into the dog days of August. So, lower liquidity. A lot of people are right in the middle of summer holiday. So it's not surprising it's given back a little bit. Also, we had a 3-year auction yesterday, which came in a little bit weak. To be honest, it tailed, and also the bid to cover ratio was the worst it's been for a while. So a little less demand shown yesterday for the 3-year auction, and that didn't help the front end of the curve. We also have had quite a lot of corporate issuance, which is not helping the bond market in general. And what we do have today we have 10s. So you see here also the 10-year, this is the ZN futures contract. We have the 10-year bond auction today. So let's see if that weakness, which we saw a little bit yesterday in the threes, holds up. And the reason for potential weakness in the 10-year and maybe even the 30-year, which we have tomorrow, so that's also just while we're talking, have a look at the 30-year, is that, we've still got the sticky inflation. And so the long end of the curve is in a difficult situation because if inflation remains sticky, that's not great for the long end of the curve. If the new Fed governor or the new Fed composition of the Federal Reserve Board is a little more dovish and inclined to cut, that means they'll be sort of fighting inflation a little less. And that's not good for the long end. And the third factor, which is not great for the long end, is let's say, for example, the US economy is slowing down and we do get some form of recession or even a mild recession. That sort of it comes with the assumption that there'll be less tax receipts, therefore more need for deficits, more need for social security spending, which means more issuance, which again is not great for the long end of the curve. So the point is, and again, we have the 30-year auction tomorrow as well. So my point here is that whichever way the curve, the bonds go, what I could say, or what I should say, is that I think that a steepening bias is still probably what's going to be happening for a variety of reasons, and either that's going to be sort of dovishly pull down the yields on the front end because the economy is horrible and the Fed needs to cut a lot, or on the other hand, the yields at the back end could remain supported in the sense it could be high if we still continue to get sticky inflation and the need for quite a lot of issuance. Now, we did have that massive sort of steepening move on Friday for the non-farm payrolls. It has again come off a little bit, but you can see already this morning just a little bit of green here, a little bit of steepening. That's the 2s 30s. If we look at the 5s 30s, similar kind of situation. And let's have a look at the 2s 10s. Again, similar situation. So we had a lot of steepening on Friday, and then it's just pulled back a little bit, maybe a bit of profit taking, just a little bit of consolidation. But it would not surprise me if all of these curves actually steepen, over the next few weeks, and maybe, certainly sort of month or 2 or 3. Let's keep an eye on that. Other things to keep an eye on, apart from my tea, is we know that the Americans imposed a 39% sort of tariff on Switzerland, which is pretty shocking, a lot more than the European Union. And so the Swiss now, at this point, they've sent their president over to the US. But what's interesting is that the Swiss president has not been able to get a meeting with either Trump or Vance or Secretary Treasury Scott Bessent, but is meeting with Rubio, which I think is a little bit of a slap in the face from the US, or at least just a sign to say, hey, we don't plan to do anything too soon about the tariffs. But nonetheless, the Swiss are concerned because their major trading partner is the European Union, but also the US is very important. And you have to say that if they cannot get these 39% tariffs down, we're already seeing reports of companies thinking about changing their production facilities out of Switzerland into the European Union. And keep in mind that overall the European Union has less onerous tariffs than Switzerland now. So could it be that some of the Swiss industrial base will move its production out of Switzerland over the border into parts of Europe, and that could lead to a little bit more unemployment going into the future in Switzerland, and a little bit more sort of political unrest. So interesting days. So let's just keep an eye on what's happening, first of all, in Washington today, if there's any talk of a compromise between the US and Switzerland, and maybe those 39% tariffs can be reduced. If not, you've got to say that in terms of growth for Switzerland, this is maybe not great. And potentially this could be sort of a weakness here for the Swiss franc. Let's keep an eye on that and see what happens. And also, as I was saying yesterday, let's keep an eye, of course, on the euro Swiss franc. just to see what's happening here. And you see already the euro is starting to pump a little bit higher against the Swiss franc, maybe on fears that the Swiss sort of industrial base and pharmaceutical base could be under a little bit of pressure. We'll see what happens there. Other thing today, there's no other data today in the US. What is interesting is that there's talk about extra sanctions on Russia. We know that Trump has sent, I think it's Steve Witkoff, over to is meeting with Putin about potential ceasefire or some kind of sort of reduction in hostilities in the Ukraine conflict. Putin is basically not given too much sort of sense of optimism around that. But what Trump seems to be trying to do is to sort of impose maybe some extra sanctions on Russian oil exports, or maybe trying to hit other countries, let's say especially India or China, which is buying Russian oil, putting sanctions on them. So potentially that could be a little bit of the oil market under a little bit of pressure and disrupting supply a little bit, I guess is what we could say. So we have seen this morning a little bit of a bounce up about, what's it, about $1 on the WTI. Brent's up a little bit more. So you see that crude oil overall, just holding this sort of level here. And as you can see here from the chart, no big surprises there. This is essentially a big fib retracement level. If we go all the way back here, we'll go on a slightly longer term fib here. You can see that this is a pretty key level here because it's the bottom of this trading range in the purple box. It's also horizontal support around about 65, let's call it about 65, 65.20 or so. And it's also a 68% fib retracement here. And there's also a little bit of a sort of a trend line, not exactly, but you could argue there's a bit of a sort of a trend line there. So the point is that if oil holds here, it's actually holding in quite well. And we're getting reports as well. There was a draw last night in the API, which is the private the private survey. Actually, I have the numbers here. Let me just check those for you and with you. I just want to look myself. Yeah, so API last night came in at minus 4.2 million as a draw. So that's positive for oil. So that means, a deficit of oil. That's for the crude. And then also gasoline came in at minus 900,000 barrels. So almost minus 1 million barrels there. Distillates was higher at 1.6 and Cushing at 1.7. But nonetheless, the oil and the crude oil and the gasoline was relatively supportive. This morning we have the official government numbers from the US at 10:30, the Department of Energy. So let's see if we get some draws and that supports what we got from API last night in terms of the inventories. But basically here, this is a pretty important sort of support level, as I say. If it seems there aren't any sort of further tariffs involved, and then global economy continues to weaken, like what we saw in the ISM services yesterday. If oil breaks through here, for sure, there's going to be some stops there. So we could get a bit of a puke downwards. And really the question will be is whether there's more downside. What I think is interesting is that OPEC Plus, we know that they increased their output by about 500,000 barrels. But if we actually look at the forward curve, which I'll just bring up. Sorry, just give me a second here to bring up the forward curve of oil, which it's going to take me a second to find it in G. Just bear with me here. Energy and the CL curve. Okay, so here's the curve for oil, and I'll just zoom in. And what you can all see here is that it's still very much in a backwardated state. So the front curve, the front contract, still much higher than further out for delivery contracts. And so this is showing to me, a relatively, sort of strong curve. If we go, let's say, a week ago, the price has come down, but the shape of the curve is still quite good. So it's not too bad. It's showing that the physical market is still relatively supported. And the other thing, I was reading some research yesterday, essentially saying that as these prices go down, some of the global producers of oil, which are more sort of high cost producers, they are slowly apparently reducing their production output. So that's what OPEC Plus is trying to achieve here. They're trying to achieve a bigger share of the global, sort of pie in terms of market share, but also they're trying to say to some of these high cost producers, hey, if the price goes down a little bit, maybe some of those guys have to reduce their production a little bit because they're not profitable. But as we see at the moment, the curve here is still relatively solid. And just while we're on that, why don't we just look at the spreads? I'll go and have a look at, let's say, CL1 versus CL6, which is the front prompt contract versus 6 months out. Let's just have a look and see if that loads up. Hopefully that'll be loading. It takes a while to load. There we go. So what you can see is that, it has come down So this is the 60-minute chart. So yeah, it has come down, but it's still very much, it's almost up at $3, which as you can see is not too bad. It's higher than it has been for a while. And we just go back here, get a little bit more perspective. Um, if that's going to load up. Yeah, so this, I believe from memory, this is the situation with Iran and Israel attacking Iran. So you see from perspective that yes, the CL1, CL6 contract, the spread has come down a little bit, but it's still, at reasonable levels. Let's call them healthy levels. I'm not going to say elevated levels above, let's say 350, 325, 350, and certainly not into sort of potential of, war disruptions at almost $5, but still at $2.80, there is a premium being paid and the curve is still in a backwardated state. So you'd have to say that, at least in terms of time spreads, the WTI market is, reasonable and not super strong, but reasonable in terms of physical demand. All right, guys. So let's just have a final look, just at a couple of charts. Uh, what we did see overnight and yesterday, let's have a look. We see that the VIX has come down. There was a little bit of a spike just on the non-farm payrolls on Fridays, but you see the VIX now not down to its lows of, sort of 14, 15 handles, but down to about 17. So still, fairly contained here. We see the ES. It did make a little bit of a recovery, but if we put that on a 4-hour chart, it's getting kind of interesting here. So let's just have a look at this and break it down a little bit and see what's going on. So all the red here obviously is what happened last Friday. But if we look and just see what the bulls need to do, so we see here Fibonacci retracement. We can see here that there was a rally on Monday, but what we notice here is that it just got to the 50 or almost up to 68% fib retracement from the non-farm payrolls number. So kind of failing there. And you have to say that at least on this, shorter term, the 4-hour chart here, the bulls, did fail at the first attempt. It's now being pressured a little bit lower and now just sideways consolidation. So let's see what's going on here because, as I say, this really to get this bullish again and try and retest the highs, at a minimum, you'd want to see the bulls take this above like a reasonable fib retracement up to maybe, 63, 6,400, something like that. Once it gets up there, you could say, hey, that they've sort of reversed the non-farm payrolls move. But at this point, I don't know that we could actually say that with any sort of confidence. And it looks as though the market's moving a little bit sideways. So let's just keep an eye on that. In other markets, yeah, as I say, let's have a quick look at oil. I think, no, I did actually show that. Something else which happened overnight is, no, just want to look at the dollar here. Let's have a look at the dollar. Right. So you see the dollar continues to be a little bit weak. Possibly that was the ISM services yesterday. Maybe it's the midsummer doldrums. There's just not a lot of energy either way, so it's just drifting downwards. But you can see that after the non-farm payrolls, it hasn't really made a pathetic attempt at a comeback. Again, if we throw this on a 4-hour chart, which I think I did yesterday, you could see here that there was, a very, very modest, I don't even know if we can call it rally, but already this morning we're seeing that sort of pushing lower. So the thing is that the dollar does seem to be sort of under pressure. And again, this could be a combination not only of a sentiment that, possibly the labor market is weakening at the Fed will cut, but also the fact that, this week we could get news on Trump's putative sort of appointment for the Fed. And, there's a lack of sort of transparency, a lack of sort of independence for the Fed, and also the Bureau of Labor Statistics will get that person's nomination as well. And so basically a little bit of sort of a little less trust in the US dollar. That's a much bigger long-term sort of abstract concept. I don't usually like to trade on things like that. But the point is here that there's just not a lot of confidence in the dollar at the moment, and maybe less confidence in the forward path of the US economy. And that's explaining the dollar weakness here. We'll keep an eye on all of that. Okay, guys, I'll leave it there. As I say, no data today. I'm going to keep a look on the auctions for the 10-year at 1 p.m. to see how that goes, and also to see what Cook and Collins might have to say about the Fed going forward and their prognostications about the economy. Okay, thank you. Take care, and we'll keep this going tomorrow. Thank you.